As a real estate agent, the number one conversation that I'm having with my clients right now is about their upcoming mortgage renewal. So if your mortgage is renewing this year, 2026, you already know you are facing higher payments. It's estimated that about 60% of all the outstanding mortgages in Canada are set to renew through 2025 and 2026, impacting a vast number of households. For many with 5-year fixed-rate mortgages taken out when rates were very low, this means a potential payment jump of 15 to 20%. But what if there's a wild card that is not in the standard forecast? A single geopolitical event could add another $400 to $500 to your payments, on top of the increase you're already expecting. I'm talking about the conflict-driven oil shock. It seems distant. I'm going to show you exactly how this chain reaction could hit your mortgage and why it's a unique threat right now. Let's talk about the problem, the 2026 renewal wall, and let's quickly cover the challenge we all see coming. By the end of 2026, a huge wave of mortgage holders in Canada will have renewed at a higher rate. Many of my clients who bought or refinanced in year 2021 secured fantastic rates, some below 2%. But today, even with the Bank of Canada holding its policy rate steady at rate 2.25 in early 2026 to observe the economic conditions, the new reality for borrowers is significantly higher. That stability is a fragile good, but it's a stable number, that much higher than what millions of people have been paying. So for homeowners who took out their mortgage 5 years ago, this renewal could mean an average payment increase around 20%, and that's the baseline problem. But the unexpected threat could turn a challenging situation into a crisis. By the way, my name is Ilham Ibrahim. I'm a real estate agent here in Vaughan. I help Canadian families buy and sell with confidence. Let's address the wild card, the oil shock playbook, and here where a perfect storm could form. While the market watches the Bank of Canada, the real wild card for your mortgage might be what's happening with the global oil supply. I'm here highlighting a risk that central banks are actively flagging. Think of the Bank of Canada as trying to keep inflation stable. The oil shock is like a new infection. The cost of gas, transportation, and producing goods all rise, pushing inflation up again. This will force the Bank of Canada into a tough spot. Do they raise interest rate again to fight this new inflation? Or do they hold steady and risk inflation getting out of control? This is how it hits your mortgage. Fixed rate mortgages are priced based on government bond yields, which are like an economic weather forecast. An oil shock is like the hurricane on the map. Investors predict higher inflation and demand higher rates on those bonds, which can keep fixed mortgage rates elevated or push them higher. On the other hand, variable rate mortgages are even simpler. They are tied to the Bank of Canada policy rate. So if the Bank of Canada hikes its rate to fight the oil-driven inflation, your payment goes up almost instantly. Let's say you have $500,000 mortgage renewing. So you might be budgeting for a new rate around 4.5%, taking your monthly payment from around $2,500 to almost $2,800 a month. Now let's stress test the oil shock. Renewed inflation fears could push fixed rate up another 1%. And suddenly that 4.5% fixed rate, now it's 5.5%. And now your new monthly payment is over $3,000 a month. That's a total jump of almost $500 a month. And that's the difference between a manageable shock and a true financial challenge. So what's the domino effect on the housing market? The oil-driven rate spike has a second major consequences. It's directly impacting the value of your home. That oil supply distribution can soar buyer sentiment, drag down asset prices, and make borrowing even more expensive. When higher mortgage rates squeeze what home buyers can afford to pay, the demand for housing cools. At the same time, some existing homeowners facing that massive payment increase might be forced to sell. So this combination of falling demand and potentially rising supply put downwards pressure on home prices. It's actually a toxic mix of high inflation and a weak economic growth. So the very event that makes your mortgage more expensive could also cause the value of your largest asset to stagnate or decline. This is a crucial risk for everyone counting on their home equity, on top of the already challenging environment that so many Canadians are facing right now. I want to know your thoughts about this potential wildcard. Are you factoring in the global risk and the potential impact on home values? Let me know in the comments below. The upcoming renewal cycle is a challenge. The baseline numbers already pointing to a higher payments. However, the biggest risk might be the one that have not been widely discussed. Understanding how a global event like the oil shock event is the first step in building a resilient financial plan for the uncertainty ahead.